Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup-Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Alan, Dunne and I, Niels Kaastrup-Larsen, where each week, as usual, we take the pulse of the global market through the lens of a rules-based investor. Alan, wonderful to be back with you this week. How are things in Dublin?
Things are good here. Great to be back. Yeah, nice sunshine in Dublin and plenty to talk about as ever.
Oh, yeah. There's definitely not much sun positives in what we're going to be talking about, perhaps. But we were commenting before pressing record that we're, for the first time in a while, both have a nice sunshine where we're sitting, respectively. But we do have a really, really great lineup of topics. I know I say that each week, but we really do. And it's going to take a while to get through that. But before we do, always curious to hear what's kind of come on your radar that's not related to the topics of today.
Yeah, well, you could pick so many different topics, but one thing, I guess, that was kind of highlighted again during the week that's going to be an important theme, I think, for the next while is just the variability and the patchiness of the economic data because of all of the disruptions that we've seen. So we durable goods orders were out during the week, and they were, I think, down 7% or 6-7%, have been up 6 or 7% the previous month. But obviously, what you've seen is a lot of stockpiling or a lot of activity ahead of the tariffs. Then you had a pause when the tariffs came in. Then obviously that it looks like when the tariffs were paused, the expectation is you would see a spurt of activity again, and now we might see another disruption in relation to obviously the court ruling. So we had already this debate going on, a difference between the hard data and the soft data. The soft data, the sentiment data, already showing a lot of pessimism and big impacts in terms of consumer and business sentiment. But then it's going to be very hard to get a read on the hard data for a while because of these kind of disruptions. So there isn't We're already at an interesting point where the economy could be turning down, and then it's hard to really get a read on that given the volatility of the data. So I think it's going to be unusually tricky in the next few months to really get a read on that. Arguably it has obvious implications for any strategies that are based on, a read of that, the kind of the high frequency macro data. So that could be tricky in those cases as well. But that's certainly something I'm trying to get a sense on. And I think, as I say, will be an added complication to the picture in the next few months.
Yeah, I mean, on that topic, I saw yesterday an interview with the head of the Port of Los Angeles. So that's the biggest port in the US. And what he was saying is that, they'd seen a little bit of a pickup in terms of ships that were booking slots or whatever it's called in the port, but not nearly as much as they would have expected with this pause. And he also said something interesting in that he said, even if you do a pause of 90 days, it's not really long enough for companies to essentially get the things produced in China, then sent to the port and then shipped over.
Yeah.
So they were definitely still seeing fewer bookings in terms of the big kind of transport ships that they normally get from China. Interesting times. So we've got so much to cover today, really, but I did came across a few things I wanted to sort of bounce by you in this little section. The first thing was a headline from the Financial Times from May 21st, so about a week ago or so. We're recording on the 30th of May. And this is something I think we may have mentioned in the past on the show, but something that kind of worries me a little bit. and that is this. There was this. It says the billionaire co-founder of buyout firm Thoma Bravo. That's $180 billion private equity firm, and the founder or the co-founder of this company was basically saying he saw worrying signs that a lot of these private equity products were now being lined up to be sold to private investors, to retail investors, packaged. And he says this is a clear sign that there's just simply no demand. They can't exit, so they're going to do an exit and put it on the private retail investor. And that's just that's a sad thing to see if that's really what's happening at the moment, which he says he sees signs of. Yeah,
I mean. Yeah, I guess it's a skeptical take on what's happening. It could well be the case. Certainly one of the big themes is obviously the low kind of level of cash coming back from private equity transactions. And I mean, that's definitely something I'm picking up speaking to institutional investors, or what they call DPI, has been unusually low, which obviously then constrains further flows back into private equity. So, I mean, I suppose the more favorable reading of the trend is the democratization of alts and of access to private markets.
Of course.
But a more skeptical take is, well, here, let's find the last buyer being private wealth or high net worth investors or retail, whatever you want to call it, and let's sell on these highly valued companies with very rich valuations. So. Yeah, definitely. I think there's an element of both aspects to it.
But it also ties into some of the conversations I've been listening to in terms of just, this boom in demand of private credit, in a sense that, it's all private, but, certainly the way people were talking about it that I listened to was, people shouldn't think that there's a lot of diversification in private credit. I mean, it's all kind of the same type of sectors and industries and lack of good credit rating that you're buying, and it's not the Google debt you're getting in these funds.
Yeah.
So it'll be an interesting thing to follow. Another headline, which I'm sure you've been following as well, and that's just this weak demand that we had in the Japanese 40-year bond auction, which, I mean, Jim and I actually been talking about this along with David Dredge for more than a year. I think we started talking about it last January or maybe even the year before, saying, follow Japan is going to be super interesting and it could have some pretty big ramifications. And now you're really seeing how yields, especially in the long end, are really, really surging in Japan. And of course, the yields are still relatively low compared to many other countries, but they're exceptionally high for many Japanese investors. And so the whole incentive to go out and buy foreign debt, which we'll talk about later on, dwindles when you see something like this. So I don't know if there's a comment or question there. Yeah. It's interesting to keep an eye on.
No, it is. And I've been keeping an eye on that one, and I found it a bit curious and kind of seen different interpretations. Obviously, we've seen the big spike in yields in Japan, but I mean, the obvious then next point is, this is going to see a huge unwinding of the carry trade. But, dollar yen has hardly moved. It's been up and down in a range around the same point. So no real surge in the yen, which might have been the obvious takeaway. Now, it could be that local insurers are selling their 40-year bonds. I have read some suggestion that they're getting out of the 40-year and moving back to the 10-year, which hasn't moved to the same degree. Or it could be that they're investing overseas. I don't know why you would do that if you can get a guaranteed, whatever it is, 2.5%, 3%, or it might even be 3.5%. This is for 40-year now. Yeah. So, it would point to the point you're making that you would say, well, Japan doesn't have to go overseas, and that would be yen positive, but it hasn't played out. And I mean, the other point is, we were all waiting for this big adjustment in Japanese yields, and the world was going to end when it happened, but it's happened, and nothing, life moves on. So I don't know, is this a delayed reaction or what? Or I mean, the reality is the BOJ bought a lot of the bonds ahead of the move. So I mean, they effectively subsidized the private sector because the BOJ bought the bonds. Now the bonds are worth much less, but the Bank of Japan wears the loss. So the private sector has dodged a bullet with the help of the BOJ. Yeah.
A headline that I saw, which I think, I knew about it, but I'm just curious to see whether it actually will follow through because we're only 12 days away. And that is, of course, that Tesla is targeting June 12th for their robo-taxi service in Austin, which I think there's been a lot of how should I say, I think Musk has put a lot of credibility on this launch.
Yep.
So that'll be interesting to see. We've had Bitcoin, Alan, new highs this week, new all-time highs, I should say, this week. And then I saw this, and again, I can't verify it, but I'm sure if this source wrote it, it's right. It says BTC's market cap stands at 2.12 trillion, higher than the market cap of Alphabet/Google. For the first time, Americans hold more Bitcoin than gold, and experts predict BTC could explode, blah, 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 to whatever number. But this thing about Americans hold more Bitcoin than gold, that kind of, if that's true, that's kind of interesting.
Yeah, I haven't seen that, but that's I haven't looked at the numbers at all. So nothing to add on that one.
All right, so before we go to the usual trend update, we're going to spend some time, and I think we're going to spend quite a bit of time on your, as we normally do, your big global macro picture. A lot of the inspiration comes from your latest Substacks that people should go and read, of course, named All Roads Lead to Higher Yields. So I'm going to let you lead on this, Alan, and then I will try and keep up.
Yeah, well, I'll give you some... feel free to jump in wherever.
Sure.
I just started writing on Substack lately, and the Substack is called Beyond the Cycle, and this post is called All Roads Lead to Higher Yields. And it's interesting, sometimes when you start writing something, it's only towards the end that the title becomes apparent, or even what way you're going with a piece becomes apparent. And that was the case writing this, because I wanted to write something on the bond market because it's so in focus at the moment. And also I had a conversation with Barry Eichengreen this week, which will be coming out in the next few weeks. So I had prepared for that. And of course, Barry Eichengreen presented a paper at Jackson Hole 2 years ago to, all the good and the great in the central banking community about high debt levels and how they're going to be here to stay. So I was very curious to get his perspective. And I think having had that conversation, it kind of cemented everything in my mind as well about the outlook. But it was, I think most people know this quote in markets about, James Carville. He was Bill Clinton's political advisor, and he made this comment back in the 1990s. It was 1993 that he said, if I died and it was reincarnation and I had to come back, I used to think I'd come back as the Pope or the President, but actually I'd come back as the bond market because you can intimidate everybody. So it's kind of a famous quote that is often repeated, and everybody kind of knows it. And it's like that kind of came to mind as I was writing the piece. And then it prompted me to go back and look at, well, what was the situation in the markets at that point in time? How intimidating was the bond market? And it's very interesting when you look at it, because, things are, yields were not radically different from where we are today, but actually the fiscal situation is way different, So if you look at the 10-year yields in 1993, had come down to about 6%, still marginally above 6%. So we're still kind of in the midst of a disinflationary period, and yields were still in that big kind of long-term downtrend from what we'd seen in the 1980s. But if you look at the deficit, it was about a bit more than 4% of GDP, and the debt to GDP ratio was about 45% of GDP. So you're wondering, what was the bond market so worried about? Where now,
right.
If you compare it to the current day, we've got debt GDP 100%. It's higher, but it's 120%. But you have to take out the bonds that are held by U.S. agencies. So it's about 100%, and it's forecast to rise. And obviously, we've got the big, beautiful bill going through Congress, which is going to add another nearly $4 trillion to the deficit over the next 10 years. So it just struck me, wow, what a huge shift we've seen, where, back 32 years ago, the bond market could still be an influence on politicians, on policy, even at much lower levels of debt and at lower levels of deficits. Because actually what happened then, Carville was Bill Clinton's political advisor, and Clinton came in, and one of the things he did was he raised taxes, he raised income taxes. So he knew that he needed to get interest rates down to stimulate the economy. The economy was still coming back after the recession of 1991, but it was a jobless recovery, it was known as, because the recovery was really slow. So the perception was interest rates were still too high to stimulate the economy. Clinton knew he needed to get the rates down. But again, very interesting thing, he had a conversation with Greenspan early in his presidency, man to man or whatever, not trying to influence him, but trying to understand the economic outlook. And Greenspan kind of made it clear to him, the best thing he could do in terms of getting lower rates would be to cut the deficit, because that would make it easier for the Fed to pursue an easier policy. Contrast that to the current day, relations between the presidency and the White House are very different, So you had a huge ideological shift, I suppose you would say, from the perspective of the 1990s, a period where people still thought, well, if you could control spending, you might actually get a positive outcome to the economy. That would bring down interest rates, and then that would help fuel investment, which is effectively what happened. Now, you did have Greenspan's new economy, a new paradigm in the 1990s, a big productivity boom, which helped as well. So you had a confluence of positive factors, but certainly, the Clinton tax hikes ultimately were not a headwind for the economy. You could say arguably they assisted that process of lower rates, the disinflationary trend, and it allowed for easier policy. The Fed did hike in 1934, but then after that, they were able to ease more, and we did see lower yields. So again, comparing that to today, very different. And obviously, what we saw on the back of the boom of the 1990s was we actually went into surplus. The US went into surplus by 2000, and all the talk was, we need to stop issuing long bonds, and I think they did for a while, up I think till 2005 or so. So it just shows you again. Now we're into a situation where they can't term out. They had to issue bills because there's concern about lack of demand for the long end. So it's kind of curious just to trace what happened along the way. Obviously, we had Bush tax cuts in 2002 or so, and then obviously we had the financial crisis, which obviously required a big fiscal response. But even that was tempered at the time. They couldn't. Like the TARP was voted down the first time.
That's true.
And then even at the time, I think. The advice from the likes of Larry Summers was like for a 1 trillion bailout, but they came in a little bit less than that. And even after that, even in the early 2010s, you remember the ideology was still austerity. Okay, we've had this big fiscal splurge. We need to claw it back. We saw it in the UK. We saw it in the US. So even by the mid 2010s, the deficits were still not that big, 3-4% or so, to back to more normal levels. But the real turning point, I think, if you look back now, was 2017 when Trump came in and the economy was doing okay. I suppose you'd had this period of secular stagnation and, a big tax cut in an economy that was already close to full employment. So, obviously, the 2017, it worked through Congress. It came in 2018. And then by 2019, the deficit was back to like 4.5%, the same as the Clinton era. But this time for an economy at full employment. So you would think that's the time to be reining in the deficit. Instead, it was expanding. So that was, I think, the kind of the turning point from an ideological perspective. And I guess in the background in this period, the second half of the 2010s, you had this idea of, modern monetary theory, do deficits really matter? We can have more spending. Come on, the bond vigilantes, that's a thing of the past. So all of that came in. And of course, interest rates were at zero. So yes, of course you could do that. It didn't really matter. And then COVID 2020 obviously required a huge fiscal response, 15% of GDP the deficit was. But then after the fact, there was no appetite for kind of deficit reduction. Instead, Biden came in and he got control of the Senate marginally, and was able to bring through big spending plans. So this was kind of, we had Gary Gerstle on before. He talked about the end of the neoliberal era, and this was kind of real evidence of it. The idea of fiscal conservatism was gone, free markets gone. It's all about, making sure the supply chains can't be disrupted, investing in domestic manufacturing, encouraging that, investing in domestic infrastructure. but all at a huge cost in terms of debt and deficits. So all the while, the debt to GDP ratio is creeping higher. Now, the US did get the benefit, in inverted commas, of higher inflation in the 2021 period, 21-2. So higher inflation does kind of reduce the real value of debt. But now, as inflation's coming down, the real value of debt is moving up again. And obviously, we've got Trump in now. And obviously, even though at the start of his presidency, there was some hope, Scott Bessen's 3-3-3 plan, remember, a 3% deficit and 3% growth. That there's no mention of that at the moment. Doge was, the great white hope. With Doge was going to be instrumental in eliminating the deficit, or at least cutting it significantly. And now Elon Musk is saying, well, the big beautiful bill is going to undermine any progress they've made. So hopes on that have diminished. So it's kind of like there's just no political appetite or ideological appetite to address this. You don't hear much of that, and it's just such a stark contrast to what we saw 30 years ago. So in the paper, I talk about the other thing around this is the idea of, it's not just the level of debt, the debt GDP ratio. That's not the key thing. It's important, but the other thing is the relationship between interest rates and growth, R minus G or R versus G. So when interest rates, when your debt servicing cost rises above your growth rate, that means more and more of your resources are going on servicing the debt than you are actually generating in tax revenue. So it's at that point, the debt becomes unsustainable. So, if you put some numbers on that, real GDP in the US, you would a reasonable expectation for it would be 2% over time. That's kind of might be 2.25%, might even be 2.5%. And if inflation is 2%, it could be 2.5%. You're probably looking at nominal GDP growth of 4 to 4.5%, maybe 4.5% is probably reasonable. That's where 10-year yields at the moment. So that's fine. It's just about imbalance. But the problem is that if yields spike up to 5% or above, then that shifts that relationship that or exceeds your growth, and it would negatively impact the growth outlook, but also the fiscal arithmetic. So you quickly get into a period of investors then balking at buying more treasuries, and the higher yields go, it makes the debt less sustainable. So you're into a vicious cycle then of higher yields, a more pessimistic outlook. So the question is are we at that point now? And that's always a tough question, because, we've got a weak economic outlook. So ironically, if we had a recession, it would probably bring yields back down, because the Fed would probably ease. And that's the pattern we've seen in the last 2 to 3 years. You get deficit concerns, but then you get weak economic activity, it brings it back down. But the other thing is, if we get a recession now, then automatic stabilizers kicking. More people claim unemployment assistance. There could be another fiscal stimulus, so the deficit would get even bigger. So it won't solve the problem, it just pushes it down for the next recovery. So that's kind of one scenario. Another scenario is the economy doesn't weaken that much, and maybe we see higher inflation in the near term, and the Fed might have to actually respond to that. So that could be the trigger point for pushing yields up in the immediate term. And I think even regardless of the two scenarios, I think a big focus is going to be kind of next year, when it's Powell's term is up, and it's going to be who will Trump replace him with. Probably, if you look at history, you've seen the idea, Nixon and Arthur Burns is a classic example of having a Fed chair who was sympathetic, or at least under the influence of the administration. So easy to see how we could see something like that. Now, obviously, there's 12 people on the FOMC, so it's not the Fed chair. It doesn't dictate, but it is a significant seat and could influence policy. So I think short term, you can paint different scenarios, but big picture, most of the scenarios point to, scenarios that where we see either financial repression, this idea of, having to force institutions to buy bonds, whether it's the Fed or the private sector, or having policy easier than otherwise you would want, and that's kind of the idea of kind of fiscal dominance. So, I think there's a classic quote from Rudy Dornbush, who's a famous economist. He says, these crises take longer to evolve than you expect, but when they happen, then they are much more dramatic and fast moving than you thought possible. So that's the classic line with respect to the bond market. I think all roads do lead to higher yields. Now, whether it's this year or next year, that's tough to say. But the big picture outlook, when you look at the trajectory of debt deficits and policy over a kind of a 3-decade horizon, it's very clear to see what's the direction of travel.
I think that the most concerning about this is something that one of our former guests, Ben Hunt, put quite well in one of his recent writings. I'm not sure whether I'm actually quoting him correctly or not, but the point was that, and we live in this kind of narrative world. That's his big thing. And it's like, that we've now crossed from this the debt might be unsustainable to obviously it is unsustainable, but the problem is nobody cares about it.
Yeah.
And it's that mental shift that sounds kind of innocent, but it's not. And we've seen that with so many things in recent years, where you just think that that's just unbelievable. I mean, similar to some of with these meme coins and all of that, and the people who get involved with them. So yeah, I mean, it's definitely worrying. I kind of fall in your category in terms of that I see more risks, and been saying that for quite a while, that see more risk to the upside in terms of interest rates. Although I do remember last year when we did our outrageous predictions, I said, well, maybe the Fed have to slash interest rates to 1% because there's going to be an AI boom. So I'm still hoping out for that, but you never know.
Well, like an AI boom is part of the narrative here as well. I mean, because obviously if you can get a stronger economic growth, it does solve things. So after World War II, the debt level jumped up in the US, and actually it was strong growth in the decades after it that helped pull down the US debt to GDP level. But the question is, how realistic is that now? And economic growth over the long term is driven by, the growth in the labor force and productivity. Obviously the US is now moving away from allowing immigrants, so that's going to impact the labor force and obviously an aging population anyway. So hard to see a strong growth driven by labor. Then it's productivity, and obviously, AI could be a huge transformation of the economy, but equally there's a huge range of estimates around this. And even with the internet, the internet came in the late 90s. It was maybe 10, 15 years later before the productivity gains were really seen. Obviously, like we had a productivity boom in the 1990s, but it wasn't the internet. It was the use of computers, which had been developed, I guess, 10 years prior to that. So there's normally a lag. So I think it's very, you're kind of being very hopeful if stronger economic growth is going to solve this. I mean, that was the idea of the Besant plan, 3% growth, 3% deficit. That would definitely satisfy the markets. But it comes back to this relationship between interest rates and growth. Yeah, if you can get the growth, that's fine. But if you can't, and interest rates are higher than the growth rate, then the market sees that, and then you get into this vicious cycle. And I think the other thing that's really concerning is if we did, say, for whatever reason, yields jump up above 5% and then quickly go to 6%, and are fast moving. Now, how do you stop that? Well, you stop it by coming up with a credible policy to address the deficit. I mean, how likely is that in the current political scenario? So hard to see that if an aggressive kind of deficit cutting policy was needed to be enacted quickly, that's hard to see.
There's no votes in doing the right thing, unfortunately, in politics. So we will be forced. I think we'll have to hit the wall before something happens. Speaking of AI, just completely random, really, but just before we started recording today, I was just watching this little short, whatever you call it, program on Bloomberg about this new Stargate AI data center that they're building in Texas. It's just extraordinary. And they were saying, I mean, if we are, and I'm sure we are getting, a massive boost to AI, this one data center, now, albeit it's a big one, they estimate it's going to be using as much energy as 750,000 homes. It's not, I think people in the rooting for the green transition, or not even the green transition, but, decarbonizing all, they must be just horrid by the thought of AI playing an even bigger role. I mean, that is incredible.
Yeah.
I didn't realize there was that much.
Interesting, yeah. Well, I remember reading something about the size of those data centers that were planned. I think it was the big one that was announced, and it was something like, 20 kilometers long and 20 kilometers wide, that kind of size. So that's kind of order of magnitude we're talking about.
Yeah. Now, a couple of things. I don't know if, but in terms of inflation in all of this, so you talk about higher yields. In terms of inflation, and now I wanted to ask you, in a sense, it seems like inflation is becoming more of a political choice from the policies that they are pursuing. I also think that you have these. You talk about your Substack with the use of cycles. I mean, many years ago, and I didn't think about it. I wasn't that much into all these things back then. But someone said to me, we go through cycles where you have either strong politicians and weak central banks, or vice versa. So clearly, right now we have strong politicians and weak central banks in a sense that they can't really do much. And then I had read this headline today where I think someone from the ECB said, they think they've defeated inflation. It's not quite the same sense you get when you look at the US. So is the interest rates going to decouple, or bond yields going to decouple from inflation to some extent? Meaning we're just going to have higher real yields because investors demand that?
Yeah, I think so. I mean, that would be the implication of what I'm saying. I mean, obviously you can have a spike in yields driven by inflation, but even without that, we've seen a big jump in real yields already, and from negative, obviously, before the COVID to, real yields to US now 2%. But as I said, back in 1993, they were, over 3%. So we've seen this. I suppose it's this idea of rising term premia, and I guess as well, you can think about it from an investor, portfolio perspective as well. As we've been saying with this, when you had that negative correlation between bonds and equities, bonds were quite valuable in your portfolio. So you might have been willing to tolerate a smaller term premium because there was a portfolio role from an investment perspective. If that's going to be more diminished and less certain that you will get kind of convexity and positive returns from bonds in an equity downturn, logically you would say it's going to require a higher yield to encourage people to hold. So I think it is. I mean, yeah, it's an open book on the inflation debate. Is it tamed yet or not? I mean, who knows? But I mean, what we're seeing, we don't know what the inflation impact is going to be from tariffs. I mean, in terms of the magnitude, we know the first order effects are pretty obvious. But at the same time, if you think about what the Trump policy is all about, re-energizing U.S. manufacturing and reindustrializing the U.S. economy, but it's an economy already at full employment. So where are the workers going to come from to do this, to build these cars, etc., or even to, all of this new manufacturing? So that's kind of, you can see how that leads to bottlenecks and skill shortages and boosts to wage pressure in certain sectors, which could spill over more broadly. So, yeah, I don't know. It's not something that people can model with any conviction, I would say.
I mean, if only Trump knew someone that was building robots at the moment.
Exactly.
Anyways, to leave on this section on a positive note, there wasn't much of a prospect of the current government, and this is actually not political. No government right now really wants to raise taxes. And then I read from this morning on the FT, they said that we begin with the US, where Wall Street is warning that a little publicized provision in Donald Trump's budget bill that allows the government to raise taxes on foreign investments in the US could upend markets and hit American industry. So apparently there is a little section in the new, it's section 899 for those who want to go and read it. It allows the US to impose additional taxes on companies and investors from countries deemed to have punitive tax policies. It would affect dividends, interest income, and US stocks and bonds and sovereign wealth funds holdings. So it may not be the US citizens that are going to pay higher taxes. It could be the rest of the world.
Interesting. Yeah, I hadn't seen that, but that's certainly an interesting angle. Yeah.
You have to get up early to follow my lead here, Alan. Anyways, let's say we've done enough for now on this super interesting topic. Let's turn to something equally interesting, of course, the trend following update. And since we are recording on the last day of the month of May, not an uninteresting month yet again. My own trend barometer finished yesterday at 30. That's a low reading. That's a weak reading. So I am expecting to see some losses once again across the industry, probably with some dispersion for sure. And obviously would love to hear your thoughts. From my vantage point, I think things that have been tricky for at least the longer term managers could be continue to be a little bit in the fixed income space with long positions have probably been challenged during May, in particular in the short end. I think that they were particularly difficult. And also, if you look at sort of those who are diversified, who trade the commodities, we've seen some reasonable corrections in coffee. So that's going to be a negative impact. And even gold has taken a little bit of a breather in the month of May. On the other side, I think a commodity market like live cattle, actually, even though it sounds like a little bit obscure, but actually it's been a pretty good market, I think. And also equities for those who did not flip positions during the April period, which will be interesting to see, where model speed, how that impacted positions. I do think, though, overall that risk levels have probably been caught in May. I think there's this lack of strong signals across most markets, and that generally leads to trend followers cutting risk. And of course, it's also interesting that with equities coming back to almost all-time highs again in some countries, we're going to be seeing trend models basically adding risk to the long side once again. What are your thoughts? And by the way, I'll just say one more thing. Maybe we talk a lot about model speed as being a differentiator between managers. It's one of 3 or 4 differentiators for sure. But a little bit unusual, I think that the medium-term trend followers are probably the ones who've had the toughest time compared to being short-term or long-term. So that's those are my observations. I don't know what your intelligence when you speak with people are telling you.
Yeah, definitely the theme of reduced risk levels is definitely one, and even not just from a mechanical response to the vol, but also to low signal levels across the portfolio. So certainly would say a lack of conviction. Where, I suppose if you look at what's happened, we had a very sharp move up until maybe mid-April and then a reversal since then. So as you say, things like FX as well, depending on how fast you were, I would think most medium term would have got on, say, the long euro trade and short dollar versus, say, the Swiss or the yen. And those have kind of been choppy and up and down in a range for now for 4 to 6 weeks. So that's been another one that could have been a bit trickier. And then obviously, as you say, on the equity side, I think, managers may have got short in US equities, but whether they maintain their longs in European and non-US, as you say, depends on speed, but would be rebuilding that. And then again, on the bonds, I definitely was seeing kind of differentiated positioning there. Managers were more likely to be getting long the US short end, which, as you say, has reversed. So we haven't seen anything. Gold had been the most obvious sustained trend, and that has paused in the last while, and nothing really has come through. Obviously, equities have bounced back. I guess if you're ultra slow and managed to not react much, that was obviously the best thing. But outside of that, it's, as you say, no surprise to hear that your trend barometer is at the lower end of the range.
No. And let me just quickly update on the numbers because they've just ticked in as of the 28th. Yesterday, we don't have them just yet, but as of the 28th, Beta 50 index was down 1.55 in May, down 4.61 so far this year. SocGen CTA index down 1.61 for the month of May, down 8.34% year to date. The trend index down 2%, roughly 2.13%, down 11.25% for the year. And the short-term traders index down 1.14% in May, down now 2% for the year. And I completely forgot actually to look up what the traditional markets have done, but I do have, I think, the S&P 500 just as a comparison as we normally do, and that it looks to have a decent month, up 6.29% as of last night, up 1% for the year. So, interesting times. And of course, with these drawdowns that we're seeing, not that they are completely unusual. They're a little bit large for some managers. They're making new all-time max drawdowns. So that's worth following, of course. But generally speaking, these periods are not unusual. And you could argue, I know we're going to be talking about it, and maybe I'll save that for in a few minutes, because the next thing we were going to talk about is the latest report from SocGen. They have just released the SG Prime Spring 2025 Investor Sentiment Survey report, where it's quite an interesting kind of a real-time snapshot where they survey 370 institutional investors or allocators managing trillions of dollars in terms of what they are looking at. So it's kind of a fascinating look into where people are focusing their efforts right now. Did you have a chance to look at it? What are your key takeaways?
Yeah, I had a look at it. Nothing massively surprising. A couple of things that maybe you could ask about. But, so they're surveying over 300 investment firms, and about 3/4 of them are kind of fund of funds, family offices, consultants, and private wealth. And then the rest is asset owners and multi-strats. And over half of these entities manage more than 5 billion. So we're talking about sizable investment firms. Unsurprisingly, I guess, the strategy most likely to be increased was global macro. That doesn't surprise me. We're in a macro volatile world, and certainly an rich in opportunities, I would say, if you're a discretionary macro or trader. Equity market neutral stat arb is the second one that most likely to see increased allocations. I think that area has done well. So I don't know if there's an element of performance chasing or being influenced by good performance of late. The third one is commodities, which did surprise me a little bit. I have to say that there is still interest in commodity strategies. Obviously, if a couple of years ago that wouldn't have been a surprise at all, but commodity markets have been generally flat to rangy. The major ones we're talking about, copper, oil, etc. So I was kind of interested to see that. And then equity long short. About 30% of allocators were saying that they would considering allocating to CTA trend and a little bit less to CTA non-trend. So still decent interest in it. Now, those numbers have come down by about 2.5 percentage points from the fall of 2024. So, there's certainly reduced interest in CTAs, which certainly wouldn't be shocked to hear that based on a tough year so far, but not massively down. The other ones that have seen less interest is quant macro, which again, it's not really the flavor of the month given this kind of market environment that we're seeing at the moment. What I mentioned at the outset with, very, a lot of choppiness in the macro data for a start, and hard to get a read on how that's influencing the economy. So the other thing was declining interest in ESG, which is, obviously the direction of travel in the US very much. So I'm sure there's a big divergence between the US and Europe in that regard. But they were the highlights for me.
Yeah, what I find interesting about this is, as you rightly say, discretionary global macro was the one that seems to have the highest level of interest from allocators. And I'm just thinking, how on earth are you going to make sense of this world from a discretionary point of view? I find it quite interesting because, of course, massively biased here, but I'm kind of thinking, kind of a non-predictive, rules-based, diversified approach might be quite useful in periods like this, because otherwise it's almost kind of flip of a coin or luck. Did you get the latest statement from the Oval Office about, it's a good time to buy equities or not? It seems to be determining your returns. And I know this is being a little bit facetious here, but still, interesting. Yeah. It'll be interesting to see.
Yeah. Well, I think we've certainly seen big dispersion in macro. Obviously, we've seen big dispersion on the CTA side, but there has been big dispersion. So, I mean, I just think it is an environment. It does offer big opportunities. Obviously, that doesn't mean every discretionary macro manager will be on the right side of it, and that's what we saw in April. Yeah. But, I guess the whole point is to kind of find asymmetric opportunities and capitalize when you can. But, it's not going to be across the board.
No. Pot shops have actually seemed to have done reasonably well through this period, or these multi-strat type funds, as far as I can tell.
Yeah. February, March seemed to be tough for them, with particularly the more equity-focused ones, with the unwind of the momentum kind of trade in that period. But April, May seems to be okay.
All right. Well, now we are back with your other topics, where again I will try to keep up. We're going in slightly different directions, but obviously touching on some of the things we've talked about earlier. So, what are these very interesting topics?
Yeah. Well, I think we've obviously had a very interesting year this year so far. And, it just strikes me a lot of from kind of working with different investors and then going to a couple of investor events. I was in London last week at a couple of events. So just kind of picking the mood across investor groups and then kind of bringing that together into, what are the big themes that I'm seeing from investor groups to concerns, or how are people changing their asset allocation or even their asset allocation frameworks? Is that because that is another topic that's coming up in some of the conversations? Maybe even starting with that one, does the whole framework need to be reassessed? So that's a question that an investor put to me. And I think, obviously you could take a kind of a mean variance optimization process, but that would always have its shortcomings anyway, but I think one thing you have to be very aware of is not kind of anchoring to returns, volatility estimates, correlation estimates to a particular period. So obviously what we're seeing now in markets is arguably quite different to what we saw, say, in the 1980 to 2020 period, where we had, a disinflation, as we said, falling bond yields. That was very positive for equity markets and financial assets, and then linked to that ultimately was the growth of private markets as well, less positive for commodities. But all of that is shifting now, so you wouldn't want to put too much emphasis on the estimate of correlation between bonds and equities from that period. So how do you weight different scenarios and different perspectives of the world? So I think that points to, taking a more of a scenario-based approach to portfolio construction, as opposed to just plugging in numbers based on average historical measures, and thinking about, what are the kind of the different possible views of the world looking ahead. So some more scenario-based analysis would be one upshot of that from kind of an asset allocation perspective, and probably kind of making sure that your optimization or your allocation process isn't overly sensitive to any assumption around volatility or correlation, because because the future could be quite different to the past.
So sorry to interrupt you here. Just want to understand, what's the difference between scenario-based analysis and not having too strong opinion about, as you say, correlations and all of that? How do you put together a scenario without being influenced by what that means for correlations and stuff like that?
What I mean is you could literally map out asset allocation plans for different macro scenarios, as opposed to just having one base case and then weighting according to maybe a subjective assessment of which type of environment you're likely to be in. Because obviously, if you were conducting this kind of analysis, say back in 2021, like commodity markets wouldn't have done great over that period, so you probably would have ended up with quite a low allocation to commodities. Now that's starting to shift, but how do you balance that versus the longer term? So rather than just doing a point estimate, it's more mapping particular scenarios and saying, well, build a portfolio for a more of a stagflationary scenario or an inflationary scenario, and then weighting that based on the different probabilities. So that would be one possible route, which I think would tilt you away from financial assets more to real assets, and it comes back to robustness, and that's the merit of having, a higher allocation to the pure diversifiers that we all advocate for, but also probably things like commodities would justify a higher allocation as well.
I want to see if you remember, because I was intrigued by your conversation recently about the annual investment return yearbook, where they look at real returns going back to 1900, so 125 years worth of data now. You probably will remember the conversation more detailed than I do, but what were their conclusions in terms of how do you best make use of the fact that you have all this data? And as you say, we can make our own assumptions and regimes and all of that stuff, but can we completely ignore the past? I mean, how did that?
Yeah.
Where did they sit on that in the end?
Yeah, it's good question, and it kind of links in with there's a couple of papers from AQR out recently around the idea of how investors form return expectations and what's the best way to do it. So it kind of links with that, because in the conversation with the guys around the investment returns yearbook, they point out a couple of things, long run equity returns. So, if you were to go back to 2000, you would have said, and they said, returns are not going to be as strong going forward.
Right.
It was an unusually
I remember
good.
that. Yes.
So they were right on that. But they would also have said, don't expect the US to continue to outperform the way it has. But they were wrong on that. So that has continued. Correct. So again, like if you're forward looking now from that perspective, what would you say? Well, expect lower equity returns would be one thing. If you're purely taking a forward-looking approach, and also expect less U.S. exceptionalism. So, notwithstanding the fact that has been the case in the last 25 years and the last 125 years, and actually the AQR paper is around this too, and they actually point out that if you look at the U.S., yes, it has outperformed over the last 15 years and the last 125 years. But we have had plenty of periods of underperformance, like the 1980s was one and the early 2000s was another. And actually, if you go back to 1990, because Japanese equities were so highly valued back then, if you look at the valuations of US versus non-US markets, US markets were valued about a half, in terms of CAPE, cyclically adjusted price at earnings. But now they've gone from being half the non-US to being double the non-US. So a big part of the component of the US exceptionalism has just been a re-ranking, a valuation change. Another interesting part of the conversation that I had with Elroy Timpson was, I made the point to him, well, investors, are bullish on the US and they expect higher returns from the US because the narrative is of US exceptionalism is, it's an entrepreneurial place, innovation, rule of law. You have all of these ingredients which are business friendly. And he made a point, well, actually, and this is kind of the academic perspective on that. If that's the case, that would mean the US is a safer place to invest, and your required
lower returns.
Your required return would be lower. Which is kind of and actually AQR draw this distinction in their paper that when we talk about expected returns, academics are talking about required returns, but market practitioners think of it differently. People in the market say, where is earnings growth going to be strongest? So that's what we're going to say. So even now, how many people would say, loads of people I talk to say, I'm going to say invest in the US. The US has always delivered. But in theory, that should be priced in. So that means, to take Elroy's point, that should mean that the required rate of return is less in the US. So future returns will be lower. That's what that means. But actually, people are bullish on the US because of the expectation that what we've seen in the past is going to continue. But actually, what we've seen from the AQR paper is that a big chunk of that is just a re-rating. So, it's just interesting how actual returns influence our thinking and the narrative. But there is an inconsistency there, I suppose I'm trying to highlight, between the kind of required return perspective and expected return perspective. The upshot is, based on all the evidence, you would expect some mean reversion. So that would point in favor of being less bullish on the US. But it's interesting as well, in one of the UK AQR papers, they say, how do you form future return expectations? You can do it based on the past, say the average, or the return in the last 10 years, or else you can construct an estimate, say, based on a forward-looking measure. So say if we were trying to say, what's a reasonable expectation for equities over the next 10 years? You could say, well, US equities have delivered 10% historically, so that's our expectation. Or you could say, well, let's look at the dividend yield and earnings growth and see, well, what might happen to equity valuations. And that would probably tell you it's going to be more like maybe 5 or 6%. So that kind of forward-looking estimate has worked better over time when you track that historically versus what was realized. That correlation is actually positive. Whereas if you do it based on the past, it tends to be negative. So that's partially because you get mean reversion, and partially because you get optimism around growth, and that get factored into returns. But actually, what's interesting is what I notice when you look at it is that what you tend to get is when the kind of the forward-looking measure is just below average. You tend to get much more negative actual realized returns. And when the forward-looking measure of future returns is above average, it tends to be even better. So, for example, if we'd gone back to 2010, like the forward-looking measure of equities returns would probably have pointed to maybe 8 to 10% equity returns, but they've actually delivered probably, say, 15% annualized. Whereas if you went back to 2000, it would have been pointing to maybe annualized returns of 3 or 4%, but actually over the next decade they were flat. So I think it is interesting that in the good times, better returns tend to get accentuated. In the bad times, it's the same on the downside as well. And we're at a point at the moment where future returns based on these kind of more forward-looking measures are pointing to lower than average returns for equity. So that does highlight some downside risk. I'm sorry, one other point I wanted to get in. Elroy Dibson, he made the point as well, about equity drawdowns. Big equity drawdowns tend to come following periods of great optimism, which makes sense. They don't come out of the blue on the back of pessimism, because obviously if the markets are very optimistic, that's when valuations become very rich, like we saw in 2000. So that was another kind of cautionary point to keep in mind. What did you make of it?
No. I mean, I thought it was very interesting, but I actually wanted just to briefly go back to the point you made about when you talk to investors and what should they do right now.
Yeah.
And you talk about having more kind of regime-based scenario analysis and so on and so forth. And so I'm not disputing that that's probably is what may happen. But I'm also thinking that in doing so, and maybe, as you say, reimagining what frameworks we should be thinking of and using in our asset allocation, that there is a higher risk of them getting it wrong, right? Because if you have 3 or 4 and you choose the wrong one, it could hurt. And so I'm obviously trying to, as you know I would do, trying to turn that back to say, well, that's actually a really good argument for having more trend following. Because I always think that, and this is something that David Redd talk a lot about, and that is, if you ask someone who is managing a portfolio, what are the risks you're trying to, you're considering that you're trying to accommodate for in your portfolio, they'll have a list of that, and they will have answers to what they're doing about those risks, and that makes sense. But then if you're asking them, so what are you doing about the risks that you haven't thought about, There's nothing on the list, right? Of course, because they didn't think about it. And I think, and I will continue to argue that our role in a portfolio, yes, some people say, oh, it's crisis alpha. I'm not so sure it really is, but I think our role as trend followers is to play the role where we don't have a specific plan or regime that we are planning for. We're planning for whatever comes towards us. And so as investors, having something in your portfolio that you're not really allowed to have an opinion about, but where we will react accordingly, regardless of what happens. I just think it's going to be a more and more important and useful tool, especially as you said, and I think you used the word robust portfolios. I mean, how do you build these robust portfolios? Well, I don't think you build them by having too strong opinions about what's going to happen in a world that seems to be changing in ways we can't imagine. So that's kind of my...
No, I agree. I mean, it comes down to diversification, which is a fairly simple and maybe obvious, but diversification means being more balanced across different risk factors and really looking into the portfolio and saying, well, what, diversification is not saying equities, private equity, credit and private credit and saying we're diversified because, obviously you're picking up a lot of the same kind of risk there. And if you have a big negative tail, everything is going to go down. So I think it's, I think notwithstanding, so I think what you're saying is correct, but I think the challenge will be, and this is, some people will say, oh, look at the environment, it's Trump on, off, it's choppy, that's going to be difficult for trend following. I don't believe in that myself. I mean, I can understand people saying that, but what history has taught us is if you try and link a trend following allocation to a particular macro view like that, you might be right for a year, but then something will happen and it'll surprise you. So I agree with you.
I mean, in a sense, this is actually, let me just as a parting point, because I do think it's an important one. If you look at track records for trend following, right? We're not, by the way, I don't think that the SocGen trend index is at new or max drawdowns, by the way. It's close, but it's not quite there, I think. So anyways, if you just look at that track record and you look at all the drawdown, just the drawdown profile, but you removed any knowledge that you might have about politics and who's in the White House and who's not in the White House and all of that, then you would say this is not unusual.
Yeah.
So I know people talk a lot about the Trump effect, and it's difficult for us as managers, but that's not an excuse, right? I mean, it doesn't matter who's in. It's not about politics. I mean, it's not about the person. It's politics change. Sometimes it's good for us. Sometimes it's bad. But often it ends up breaking something that we can then latch on to as trend followers. So I think it's less about the person in the Oval Office, and it's just about, this is one of these typical periods where markets are not trending. So don't expect trend followers to make money.
Yeah.
That's, end of story.
Yeah.
And so, but
no,
of course.
We had this before all of these things change. We had, like in 2019, there was a view central banks can control the markets, that will never trends again. So, it's not
right.
I mean, if you came up with that view in maybe 2016, you were right for a year or two, but then, when do you change it? 2019, I think was decent for trend following. 2020 was, 2021 was fantastic. So if you wait for it to be very obvious, it's going to be, I would say it was probably by 2022 when it was kind of mainstream. Oh, this is a great environment for trend following, but you'd already had 4 years. So that's the nature of it. Don't try and time it. You just have to stick with it.
Yeah, no, absolutely. Alan, this was great. This was, thank you so much for all the prep you did. And really enjoyed the conversation as usual. If you also enjoyed the conversation, as I know a certain blind squirrel did, because he left a very nice rating and review that I picked up on this week. So thank you very much for that. And he knows who he is, of course, and everybody else who follows him on Substack. But you can, of course, express your appreciation to Alan and all the other co-hosts by going to your favorite podcast platform and leave a rating and review. As you can tell, I do read them. So we really appreciate that. Next week, I'm kind of a little bit unsure who I'm with because I forgot to look it up in my schedule. Pretty sure it might be Rich. It in any case, whoever is going to be speaking with me next week, it's going to be fantastic. So tune back in a week's time. Make sure you have a fantastic weekend. As you can tell, Alan and I, we're going to enjoy some sunshine. You've got babysitting duties, Alan, I know. I've got no babies to babysit anymore. They're too big for that. So I might enjoy the sunshine. In any event, from Alan and me, thanks so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.